Welcome to the National Credit Awareness and Resolution Association podcast at ncara.org, N-C-A-R-A.org, your source for navigating debt repayment challenges during tough economic times. Today we'll explore how small business owners can more effectively use Creditor Tools, specifically interest, accrual, and non-accrual. NACARA aims to bridge the gap between debtors and creditors as a paradigm shift allows debtors to propose their own repayment solutions. Let's get started. Okay, the first thing we want to do here is talk about the accounting procedures for the treatment of interest on your commercial loan at the bank. Your loan is either going to be on accrual or non-accrual. This is the accounting treatment of the daily interest that accrues on your loan. Accrued but unpaid interest amounts, in other words, you pay every 30 days or every 90 days or what have you, all that interest that's accrued every single day, okay, it will be recognized as income to the creditor once that interest is paid by you, okay? And then there's also a couple of conditions, okay, that will prohibit a lender from recognizing that accrued interest potentially as income. And that is only going to happen if the lender expects your loans will be repaid according to the terms. In other words, if there's a condition of default and your loan is 90 days past due for non-payment, okay, unless that loan is both well secured and in the process of collection, meaning like it's got a piece of real estate with tons of equity and they're in the process of foreclosing on that real estate, okay, they have to turn that interest off, okay? It switches over to non-accrual interest. And once it's on non-accrual interest, and there's another condition that they also have that could also place your loan on non-accrual, and that's if for any reason they don't expect full principal and interest to be repaid at some point. So if they doubt that they're not going to get all of their money back, they have to switch the accrual, stop taking interest and recognizing interest into their income, and they have to put the status of your loan on non-accrual. If they have any doubt they're going to get their full principal and interest back, or if it's at least if it hits 90 days past due without any payment, and again, unless the loan's really well secured and then in the process of collecting, like on foreclosing on collateral, in the process of collection, they can't recognize the income if any of those things happen. So you can see why the lender wants to get your loan performing again quickly. So time is of the essence, okay? Every single day really, really matters. They want to restart that interest income, or they just want to move your loan out of the bank altogether. Now, let's suppose that your loan has been past due for at least 2 months, okay? Not 90 days yet, but maybe 60 days. But once they go ahead and place that on non-accrual, any of that accrued interest that's been sitting, that it accrued for like 60 days, but that's unpaid by you, the lender would be required to reverse any such interest not yet recognized as interest income and essentially stop accounting for further accrued interest into their income each month. So as you can imagine, a creditor is going to be really excited to get this loan performing again, which means they'll also put it back to what's called a pass credit risk rating so that they can turn the loan back into an accrual interest earning loan. Okay? And as you can imagine, loans are often restructured and in the best interest of both the lender and the creditor to help ensure their prospects of repayment. In other words, they want the best repayment, their least loss. They want the fullest amount they can get and as soon as they can get it. And so with a properly restructured loan, okay, it need not remain in a non-accrual status forever. So if you've got a loan that had some trouble, it went 90 days past due, and you had to do some serious modifications and so forth, it's very, very possible that part of the loan that's performing could actually be returned to accrual status. Okay, generally, sufficient time is given, for example, at least 6 months to document the receipt of regular payments being paid as agreed. This would be like on a restructured loan, to support the decision to return a loan from its non-accrual status back to an accrual status. The key is to show repayment is sustainable. That's what the lender is required to do, is show that the modified loan or the restructured loan can be, in fact, repaid under the new terms. So after half a year, that's pretty good evidence that there's an ability to repay on those new terms, and therefore the financial institution can start to accrue interest into their earnings again. And to restore a credit to accrual status, the principal and interest payments need to be current, and the creditor needs documented support to show it fully expects the loan to be repaid under the current terms. So just because somebody came up with some money to pay 6 payments does not mean that the lender's through. They need to actually document the file and show that from a financial performance or pro forma and a projected outlook or what have you, that the loan can in fact be repaid. It's actually got to be documented in the file. It can also apply to when the loan becomes well secured and in the process of collection. So why is all of this important to you? Okay. Interest on your loans that you owe will keep accruing, even if you go through one of these non-accrual workout situations, forever until it's paid. Keep in mind, if your loan is 90 days past due, and while the lender isn't posting accrued, or in other words, taking in accrued but unpaid interest into its income, your loan is on non-accrual, the system, the accounting system, continues to calculate the interest payable that you'll be required to pay anyway, because, as you know, interest never sleeps. It doesn't even take a nap. It's just that the creditor isn't taking accrued interest into income while your loan is in non-accrual status, but the system will keep track of all that interest you owe on your side of the table. Okay. This short ad is sponsored by the Debt Crisis Problem podcast. Attention listeners, please join us at tunabudget.com to tune in to the Debt Crisis Problem podcast, where in plain English we discuss 20 risks that could soon fuel a serious economic downturn. We explore these critical risks and offer practical insights for navigating financial uncertainty. Join us for thought-provoking discussions that encourage transparency and awareness. Subscribe now to stay informed and be ready for whatever comes next. As I mentioned before, non-accrual status is a very big deal. Lenders do not like non-performing assets, loans where they're not making any money because they stopped taking accrued interest from your loan into income. Again, if your loan is 90 days past due, or if the lender has any doubt about eventually collecting the entire balance, the loan will stop accruing interest on the lender's books, but your loan will continue to accrue interest forever until it is repaid in full. By this stage, lenders will have made every effort to bring the loan back to a zero balance. Unless you have been able to restore the financial performance to acceptable levels, like you've got sufficient cash flow to repay, a creditor does not want to have any non-performing loans laying around, as a concentration of non-accrual loans will bring regulatory scrutiny really quickly. And let me give you a quick example of accrual and non-accrual. If you have a loan relationship, their payments went bad for some 90 days or so, the loan was actually put on non-accrual. There was only a certain amount of ability to repay, let's say about 60% of the loan. So the lender might set up a deal where split the note into 2 pieces. The loan A is 60% of the original balance. Loan B is the other 40%. So they would just charge off, the 40% portion, because you have the ability to repay the 60% portion on time and so forth, but not the 40%. Okay? Obviously, the charged off portion is going to be on non-accrual. It's charged off. It's written off the bank's books, but you still owe it 100%, even the interest that would otherwise, the shadow interest, if you would, that's accruing. Now back to the 60% Part A loan, okay? That's still on non-accrual because you're in the middle of a big workout situation. Well, once you start making the payments for Part A, that 60% portion that's remained, for like 6 months, and like I said earlier, if you have full documentation and financials to show that you can, in fact, make those payments, those reduced payments, then after 6 months or so with full documentation, like I said, that loan A, the 60% portion, can be put back on accrual. So it's a bankable asset again. Okay? Then 5 years later, let's say you pay off loan A, okay, and you just keep paying the same payment, or you can actually renegotiate it, I'm sure, making payments toward loan B that the bank had written off earlier. You still owe it. It'll have, normally when that happens, though, they usually put loan B at a 0% interest rate. So you just owe the principal amount typically. Of course, they can leave the regular rate in, and they can have you pay all the accrued interest that is on your side of the books for the last 5 years, maybe even at a default rate. But all those things are up for negotiation, right? But the point is you pay off loan A, it can be returned to accrual status after some 6 months of making payments on time. And if you have documentation to support that fact, they'll return it back to accrual. And just when that is paid off, then you start paying on loan B. So that's how and they, by the way, once it's charged off, none of those amounts go back into the interest and principal that you repay on the charged off loan. They don't go back into it's not a loan anymore. It's been written off. So it just goes back into straight into income as a recovery on the financial institution's books. Well, thank you for joining with us today. We covered the creditor tool interest, accrual, and non-accrual as debtors prepare to propose their own repayment solutions. We want to hear from you. Share your own credit risk memo and debt repayment experiences, questions, recommendations with us at nacara.org. If you found today's episode helpful, please subscribe for notifications of future podcasts. Your feedback helps small businesses stay in business. Until next time, step forward and take responsibility for your own debt repayment solutions. Thanks again.